Robschild, nothing I say is investment advice. I wanted to do a video based on the idea that PE ratios have become irrelevant, and they are not irrelevant, they are important. They've become irrelevant since about 1995, and I believe that we are in a major stock market bubble, perhaps bigger than the stock market bubble of 1929. This is a chart of PE ratios, as you can see from the top. The TTM means trailing 12 months, so wherever it's at, it means it's basically the average of the past 12 months. This chart dates back to 1871. This is a long-term chart. On this side are the PE ratio numbers. As you can see, from 1871 up until about 1995, PE ratios ranged in a normal range below 19 and would not often get below around 7, but above 19 was abnormal. And today, since 1995, we've seen something completely different. We've seen an average basically ranging maybe even up as far as around 30, 25, 30, something like that. Now, this giant spike was during the financial crisis. Now, going this high didn't mean that stock valuations got that high. It means that earnings actually went down, and so when you have how much money companies were earning at that time, it was so low that the PE ratio had spiked, looks like above where this chart even ranges out, around 132. And so it's expected that we'll have spikes going to abnormal places higher when earnings are contracting, when they may even get to zero or negative in serious times of recession or depression. However, when we look back to 1929, we don't see it even ever go above 20 for the average of the 12-month trailing S&P 500 index. So who cares? Who cares? Stocks are just worth more now because we believe in them, because companies, are more secure now. The S&P 500, the companies that are in there are just better investments, and they're going to last longer, and the future returns of the investment, the future earnings of those companies add up to, what is expected as a good return into the future. Is that really what's going on here? I have my extreme doubts. Just to put it into very clear perspective, a PE ratio of 20 is a 5% return to the company, not to the investors, to the company. And so a 5% return, from an equity standpoint, for averaging every year 5%, that's not actually all that high. In fact, treasury bonds right now are yielding over 4%. And very recently, the 30-year treasury bond was, for a brief moment in time, yielding over 5%. As a form of investment, the value of a stock can go to zero, and it doesn't matter. Bonds are bonds. and treasury bonds are guaranteed. And so you must expect a better return from your stocks than you do from bonds. But when bonds are yielding 5%, the equivalent of a PE ratio of 20, and today we have the S&P 500 at a PE ratio of 28, something's not quite right. Something's got to give. Stocks did not magically become infinitely more valuable. I do not believe that since 1995, the form of stock investing has become that much more valuable than guaranteed returns in bonds. Markets are not making any sense right now. And I am not going to be surprised if we see another Great Depression coming very soon to a city near you. And that's all. Hope you enjoyed this video. Thank you for watching. Robschild.